Do you remember this ad? And more specifically, this dog? Well, this is the ad of Hutch, which used to do business in India up until 2007. In 2007, Hutch sold its India business to Vodafone, and which led to one of the most high profile income tax cases in India, which we are going to cover today. Vodafone, a UK-based company in 2007, was one of the largest operators in telecom sector, and it set its sight to get into the fastest growing economy of the time, India, to expand its business. And so it decided that it will enter into India by buying Hutchison's business. Hutchison Group has entered into a joint venture agreement with the SR Group of India to do the business in India, and it was called as Hutchison SR Limited in India. Now, Hutchison Group owned 66% of that company and SR Group held 33%. But Hutchison did not hold it directly. Hutchison is a Hong Kong-based company, but that company did not own shares in the Indian JV. Rather, the shares were held by a CGP Investments Limited, which was established in Cayman Islands, and the only purpose of that company was to hold shares in India, which was a wholly owned subsidiary of Hutchison Telecommunication International Limited, a Hong Kong-based company. Now in 2007, Vodafone bought the business of Hutchison SR Limited, the shares of Hutchison Group in the Hutchison SR Limited, the Indian business, but it did not buy the shares of the Indian company. Rather, it bought the shares of the Cayman Island company. And it bought the shares not directly the Vodafone company in UK, but rather another subsidiary in the Netherlands called Vodafone International Holdings BV, which bought 100% shareholding of CGP Investments Limited from Hutchison Telecommunication International Limited. That means the shares of a Cayman Island company was transferred, and this deal took place outside India. The reason we will discuss. Well, for any income to be taxable in India, it should either accrue or arise in India or should be received in India. Now, the deal was done outside India so as to avoid receipt being in India. And by transferring the shares of Cayman Islands company, the two parties wanted to show that what was transferred was not based in India, and so it shall not be taxable in India. Rather, it shall be taxable in Cayman Islands, which is a tax haven country, so that Hutchison Group does not have to pay any capital gains tax in India. Now you would be wondering that the capital gains liability should have come in the hands of Hutchison Group. So why this case is called Vodafone Group and not the Hutchison Group case? Well, this is because of the Section 195 of the Income Tax Act. Now, Income Tax Act requires deduction of TDS by certain parties, and Section 195 deals with any payment made to non-resident which is taxable in India. According to the Income Tax Department of India, this transaction was taxable in India, and so TDS should have been deducted by the payer, which is in this case was Vodafone Holding Company BV Limited in Netherlands. Now, Section 195 does not differentiate between a resident and non-resident. It calls for all payers to deduct TDS under Section 195, and so accordingly, Vodafone was held assessee in default, and it was given a notice under Section 195. After receiving the notice of demand order from the Income Tax Department, Vodafone went straight to the Bombay High Court, filing a writ petition to quash that notice. But the case went against it. The court held that what was transferred were not the shares in the Cayman Island company, but rather the business of India that was held by that company. Now you may note that the CGP Investment Limited was established solely for the purpose of holding shares in the Indian business. And so accordingly, Vodafone was held as a in default for not deducting TDS by Bombay High Court. But Vodafone finally got relief from the Supreme Court of India, which held that the AO had no jurisdiction to track this transaction, as it held that the transaction did not arise in India, neither there was any receipt in India, and so it was not taxable in India. And if it is not taxable in India, there is no requirement to deduct TDS, and accordingly Vodafone was given relief in 2012. That was what Vodafone thought at the time. Post the result of Supreme Court in the Vodafone case came the Finance Act of 2012. It went about bringing a whole host of changes, especially in the Income Tax Act, but the one that changed all the dynamics for Vodafone Idea was the amendment to Section 9, which now included that any transfer of shares of a company which holds derived value, a substantial value from assets held in India, will be deemed to be taxable in India. But even more than that, this amendment was given a retrospective effect. That means this amendment was applicable from 1961 onwards. What it meant was that the transaction between Hutchison Group and Vodafone was now taxable and Vodafone was liable to deduct TDS. And accordingly, a new notice was sent to Vodafone in this case. After the amendment, Vodafone realized that no court in India can save it from the income tax department. But Vodafone then invoked the bilateral treaty between India and Netherlands. Even though Vodafone is an UK-based company, the assessee in default here was the Netherlands company, and so the Indian-Netherlands tax treaty was called into question, and the matter went into the Permanent Court of Arbitration. And there, Vodafone won unanimously, and it was held that India had no right to tax Vodafone based on a law that did not exist at the time the transaction occurred. And so, accordingly, Vodafone survived the case. But its business did not do that well when the result was announced in 2020. The arbitration case gave a temporary respite for Vodafone, which was already troubled with its business in India. It merged with Idea in 2018 to create what is now called Vodafone Idea or VI. But the business is still struggling from the case of the AGR dues and also the disruption caused by Jio. By the way, Jio was entered into one of the industries which was kept reserved for Anil Ambani during the succession of Dhirubhai Ambani's properties between the two brothers. It is one of the most high-profile family dramas of succession in India, and we will definitely cover it in one of our future videos. So subscribe to MergerVerse if you like these videos.